In this lecture, we are going to learn about second principle of managerial economics, which is time perspective. So managerial economics, we all know it is both conceptual and metrical. It is used to understand and identify the underlying concept of business. The contribution of economics to managerial economics lies in certain principles. So those 6 principles which are considered as a basic principles or fundamental principles of managerial economics are incremental principle, concept of time perspective, discounting principle, opportunity cost principle, equi-marginal principle. So in this video, we are going to learn about concept of time perspective. Time is very crucial in a human life. In business, we consider time as money. So time plays a decisive role in economic theory, particularly in the field of pricing. Marshall has introduced the element of time in his value theory. He convinced 3 market forms based on time: very short period, short run, long run. Very short period is most of the very short run is a time period of 1 day or a 2. Short run is if the time period is below 1 year, we consider that as a short run period. Long run, anything beyond 1 year, we call that as long run. So the combination of these 3 includes time concept as per Marshall. It is the duty of the managerial economist to balance revenue and cost in his business. So it is not only important to balance his revenue and cost, it is also important to balance both in short run as well as long run period. Managerial economist is considered with short run and long run effects of decisions on cost and revenues. A decision should take into account both short run and long run effects on revenue and cost, giving appropriate weight to the most relevant time periods. So it means the decision taken by the managerial economist should consider both long-term and short-term impact of the decision. Ignoring a long-term impact and taking a short-term decision may not be advisable for a successful business execution. A decision made on the short-run considerations may in long run prove less profitable than at the first. A decision taking on the basis of long run may prove less profitable or may throw the industry into a situation to face losses in short run. So the firm should take into consideration both long run and short run effects on cost, revenues, customer reactions, and also the image of the company. So let us understand the principle of time perspective with an example. For example, XYZ is a firm engaged in a continuous production of a commodity A in long run. In the production process, it is having daily and idle time or free time for few hours. In that idle term, firm can take an order for manufacturing other similar goods instead of wasting the time. By manufacturing goods in idle time, firm does not incur any fixed costs like wages, salary, rent, etc. because the existing idle capacity is used to manufacture other similar products. So the fixed cost is absent in production, which is done in the idle time. Generally, in production of goods, fixed and variable cost is present. However, here the production made in idle time, fixed cost is absent. This shows that the cost is reduced in the production that is made in idle time. Investment made in the business can also be recovered very quickly and even in short time by expanding the services or by optimum utilization of time with the existing resources. In continuation with the hypothetical example, suppose there is a firm with a temporary idle capacity. An order of 10,000 units comes to the management's attention and the customer is willing to pay rupees 4 per unit or rupees 40,000 for the whole lot, but not more than that. The short run incremental cost, ignoring the fixed cost, is only rupees 3. Therefore, the contribution to overhead and profit is rupees 1 per unit, or we can say it as 10,000 for lot. From the above example, the following long run implications of the order is to be taken into account. First, if a management commits itself with too much of business at lower price or with a small contribution, it will not have sufficient capacity to take up business with higher contribution. If the other customers come to know about this low price, they may demand a similar low price. Such customers may complain of being treated unfairly and feel discriminated against. So in the above example, it is therefore important to give due consideration of the time perspective. A decision should take into account both short run and long run effects on revenue and cost and maintain the right balance between long run and short run perspective. So it is the duty of the managerial economist to identify or to justify the outcomes with respect to his particular firm. In this example, managerial economists have two options. Either he can go for a short-run profit by accepting the order and utilizing the idle capacity to make more profit. If we see the long-term effect, it is not the same. It will give an impact that lower price or that may demand for a similar lower price in future. Customers may demand products in future for a similar lower price. Any change in price may have dissatisfaction among customers. So in long run, the managerial economists may lose the customers. So hence, it is the duty of the managerial economist to justify both the outcomes either in short run and long run and get the result done and take appropriate decision